Hello and welcome, dear traders and investors. I'm glad to present you the market review prepared by analysts and experts from fx.co portal. Here we go. Today is January 4, 2023, and we're starting from the euro-dollar pair. The review in a whole presented by Irina Monzenko. The US dollar index hit a 3-week high Tuesday amid rising risk sentiment, a decline in US stock market, pessimistic comments from the IMF had, disappointing news from China, and political turmoil in the House of Representatives. All these fundamental factors allowed dollar bulls to remind itself again, also in pair with euro, which found itself under additional pressure against the background of the failed German inflation data. After briefly soaring to the seven-figure area earlier this week, the euro-dollar pair dropped to 1.0520 on Tuesday, updating the 3-week price low. But at the start of the European session on Wednesday, the situation changed. The US dollar index retreated from the local high, and the euro-dollar pair in turn retreated from the local low. According to the data published Tuesday, inflation growth in Germany slowed down more significantly relative to the corresponding forecast estimates. Preliminary estimates suggest that the general consumer price index rose in December by only 8.6% in annual terms against the forecasts of a decline to 9.1%. The indicator has been falling for the second month in a row, which indicates a certain trend. On a monthly basis, the headline CPI came in at minus 0.8%, with the forecast decline to minus 0.6%. In this case, the indicator has been in the negative area for the second month in a row. The US stock market also provided indirect support to the euro-dollar pairs due to increased demand for a safe dollar. US stock indices ended in the first trading session of the new year with a decline. Disappointing macroeconomic data from the China Market Manufacturing PMI, official manufacturing PMI, reminded traders of the implications of easing the zero-COVID policy. The unprecedented outbreak of the epidemic was reflected in December figures. The news that the US House of Representatives, for the first time in 100 years, failed to elect a speaker on the first attempt was a kind of cherry on the cake. Given the fact that this is the first time such a situation has arisen since 1923, and the position of the Speaker of the House of Representatives is the third position in the hierarchy in the US power vertical, traders also reacted to this fact. However, on Wednesday, buyers of euro-dollar pair were able to win back part of the lost positions due to several fundamental factors. First, ECB Governing Council member Martins Kazaks made hawkish comments saying he expects significant rate hikes at the February and March meetings. Such words sounded quite unexpected given the significant slowdown in German inflation. Secondly, the notorious gas issue provided indirect support to the euro. Today, it became known that the cost of gas in Europe has dropped below 750 per 1,000 cubic meters for the first time since February 18, 2022. Thirdly, today's rise of the euro-dollar pair was caused directly by the decline in the US dollar index. Traders took profits, thus interrupting the dollar mini rally. Market participants do not risk investing in the dollar ahead of the events expected today during the American trading session. Thus, euro-dollar traders de facto cannot decide on the price movement vector. After yesterday's decline to the bottom of the fifth figure, the buyers were able to seize the initiative, going to the area of the sixth price level. But the situation is uncertain, both for the bulls and the bears of the pair. The next in line, Oscar Tone. He has a trading plan for US dollar index. The US dollar index rallied through the 104.50 during the New York session on Tuesday as projected before facing resistance. The index has slipped sharply towards the 103.50, 103.60 area as the European session opened on Wednesday. The drop could be still considered as a pullback before the bulls are back in control, pushing the price towards 105.50 and 107.00 respectively. The US dollar index might have terminated its larger degree corrective drop at 103.05, as seen on the 4-hour chart presented here. It further managed to curve a higher low around 103.12 last week before producing a rally of over 120 points. Ideally, the bulls would keep control and push the instrument through 107.00 at least, provided that 103.05 holds well. The short-term wave structure could be described as follows. The first leg higher was completed at 104.50 on Tuesday, and the second wave retraced back to the 103.50, 103.60 zone. If the above structure holds well, prices would stay above 103.05. Continue pushing higher as the third wave unfolds. Only a break below 103.00 would nullify the above bullish structure. We've got a trading plan for NZD-USD pair by Ralph Shadler. The NZD-USD pair come back higher after failing to reach the 0.6200 psychological level. Now it's trading at 0.6339 at the time of writing. After its strong growth, we cannot exclude a minor retreat. The price could come back down. Technically, 0.6355 represents an upside obstacle. You can see on the 1-hour chart that the NZD-USD pair dropped after reaching this level in the past. After jumping above the downtrend line, the pair was expected to develop an upside reversal. Jumping and stabilizing above 0.6355 could announce further growth and brings new buying opportunities. Testing and retesting 0.6352, this upside obstacle, and staying below it could announce a new downside movement. That's all for today. See you next time. Good luck.